Hello, my name is Troy Atkins, and I am the founder and owner of Atkins Capital Management. I want to talk to you today about reverse mortgage loans in order to help you better understand these types of complex financial products before obtaining this type of loan. This presentation provides an assessment of everything that prospective borrowers should understand before obtaining a reverse mortgage loan. Before I begin, I want to bring to your attention that this presentation only pertains to HECM reverse mortgage loans. The vast majority of reverse mortgage loans fall in this category. In addition, it is important to note that the cost analysis included in this presentation only applies to an HECM reverse mortgage loan with a single disbursement payout provision. More information about additional types of disbursement options is addressed in this presentation. It is also important to note that the information that was used to generate this report was obtained from a recent report produced by the Government Accountability Office. More information about the GAO study can be found at the end of this presentation. A reverse mortgage loan is a special type of loan that is used by older Americans to convert the equity in their homes into cash. Reverse mortgage loans are designed to help homeowners who are house rich but cash poor stay in their homes and still meet their financial obligations. A reverse mortgage loan is aptly named because the payment stream is reversed. Instead of making monthly payments to a lender, as with a regular mortgage, a lender makes a single payment or a series of payments to the borrower. A reverse mortgage loan must be repaid to the lender when the borrower dies, sells his home, or no longer lives in his home as his principal residence. A reverse mortgage loan does not require a loan repayment for as long as the homeowner lives in his home. Eligible property types for a reverse mortgage loan includes single-family homes, manufactured homes, qualified condominiums, and townhouses. In 1989, the reverse mortgage loan became a tool for senior Americans when the United States Congress authorized HUD through the FHA to create the Home Equity Conversion Mortgage Program. In 1996, an additional type of reverse mortgage loan became available when Fannie Mae created the Homekeeper Reverse Mortgage. In 2017, 55,332 reverse mortgage loans were obtained by homeowners across the U.S., with approximately $10.6 billion in financing provided through an average principal loan limit amount of $191,793 and an average loan interest rate of 4.585%. As of 2019, according to both the GAO and the HUD, the vast majority of reverse mortgage loans are insured by FHA under the HECM program. The criteria for obtaining a reverse mortgage loan is specific. First, the homeowner must own his home, and generally all of the homeowners must be at least 62 years old. Second, the home must be the homeowner's principal residence, which means that he must live in the home for more than half of the year. Third, for the federally insured HECM program, the home must be a single-family property, a 2 to 4 unit building, or a federally approved condominium or planned unit development. For Fannie Mae's Homekeeper mortgage, the home must be a single-family home, PUD, or condominium. And finally, reverse mortgage loan programs generally do not lend on cooperative apartments or mobile homes, although some manufactured homes may qualify if they are built on a permanent foundation, classed and taxed as real estate, and meet other requirements. The legal provisions of reverse mortgage loans are comprehensive. First, Reverse mortgage loan lenders require homeowners to pay off any debt against their homes before obtaining a reverse mortgage loan. Second, reverse mortgage loans are not taxable and generally do not affect Social Security or Medicare benefits. Third, reverse mortgage loans allow homeowners to retain the title to their homes. Fourth, reverse mortgage loans must be repaid when the last surviving borrower dies, sells their home, or no longer lives in the home as a principal residence. And finally, in the HECM reverse mortgage loan program, borrowers can live in a nursing home or other medical facility for up to 12 months before the reverse mortgage loan becomes due and payable. Reverse mortgage loan proceeds are distributed in a number of ways, including single disbursement, term disbursement, 10-year disbursement, line of credit, modified term, or modified tenure. Each of these options has an adjustable interest rate provision associated with the reverse mortgage loan, except for the single disbursement option, which is a lump sum distribution that has a fixed interest rate provision. The amount of money that can be borrowed via an HECM reverse mortgage loan depends on three factors. First, the age of the youngest borrower or eligible non-borrowing spouse. Second, the lesser of the appraised value of the home or the FHA mortgage limit as of the date of loan closing. For calendar year 2019, this amount is $726,525. And third, the expected average interest rate associated with the reverse mortgage loan. The amount of money that is available to prospective homeowners via a reverse mortgage loan is dependent upon the principal limit factors established by the HUD. HUD has established HECM principal limit factors in order to provide the percent of maximum claim amount allowable in total cash draws, given the age of the borrower and the expected interest rate of the loan. On October 2, 2017, HUD established new PLF factor tables. These factor tables can be found on the HUD.gov website. The PLFs vary by age and interest rate across the full ranges of ages and interest rates covered by the tables. For HECM reverse mortgage loans with a fixed interest rate loan provision, the expected interest rate that determines the PLF is the actual note rate on the mortgage loan. For HECM reverse mortgage loans with an adjustable interest rate loan provision, the expected interest rate is calculated as the sum of an underlying index rate and the lender's index margin. For calculation of interest accruals on HECM loans, the lender's index margin is added to the actual interest rate index used for loan funding. The type of index used for PLF determination must match that used in the loan documents and for interest accruals. As an example of the PLF factor tables that can be found on the HUD.gov website, the table below provides the principal limit factors for prospective home borrowers between the age of 62 and 95 in an interest rate environment ranging between 4% and 4.875%. In such an environment, between 41.7% and 75% of the appraised value of the home is available to homeowners via a reverse mortgage loan. The PLF factor will be higher for older borrowers, and the PLF factor will be higher in a lower interest rate environment. The cost implications of reverse mortgage loans are comprehensive. Lenders generally charge origination fees and other closing costs for a reverse mortgage loan. Lenders also may charge servicing fees during the term of the mortgage. The lender generally sets these fees and costs. The amount that a homeowner will owe on a reverse mortgage loan generally grows over time. Interest expense is charged on the outstanding balance and is added to the amount owed each month. The homeowner's total debt increases over time as loan funds are advanced to him and interest accrues on the loan. As previously discussed, reverse mortgage loans may have fixed or variable interest rates. Again, most reverse mortgage loans have variable interest rates that are tied to a financial index and will likely change according to market conditions. Reverse mortgage loans can use up all or some of the equity in the homeowner's home, leaving fewer assets for him and his heirs. However, a non-recourse clause found in most reverse mortgage loans prevents either the homeowner or his estate from owing more than the value of his home when the loan is repaid. This is a very important provision for borrowers to remember. Likewise, the homeowner retains the title to his home after obtaining a reverse mortgage loan. As a result, the homeowner remains responsible for property taxes, insurance, utilities, fuel, maintenance, and other expenses. Therefore, if the homeowner does not pay these expenses, he risks the reverse mortgage loan becoming due and payable to the lender. Finally, interest expense on a reverse mortgage loan is not deductible on income tax returns until the loan is paid off in part or in whole. There are 5 types of reverse mortgage loan expenditures. The homeowner can pay for most of the costs of an HECM reverse mortgage loan by financing them and having them paid from the proceeds of the loan. The HECM reverse mortgage loan includes origination fees, mortgage insurance premiums, third-party charges, interest expense, and servicing fees. The reverse mortgage lender will discuss which fees and charges are mandatory. The first type of reverse mortgage loan expenditure is the origination fee. The homeowner will pay an origination fee to compensate the reverse mortgage lender for processing the HECM loan. A lender can charge the greater of $2,500 or 2% of the first $200,000 of the home's value, plus 1% of the amount over $200,000. HECM origination fees are capped at $6,000. The second type of reverse mortgage loan expenditure is the mortgage insurance premium. The homeowner will be charged an initial mortgage insurance premium at closing of the loan. The initial MIP will be 2% based on the maximum lending limit of $726,525 or the home's appraised value, whichever is less. Over the life of the loan, the homeowner will be charged an annual MIP that equals 50 basis points, which is 0.5% of the outstanding mortgage loan balance. The homeowner will incur a cost for FHA mortgage insurance. The mortgage insurance guarantees that the homeowner will receive expected loan advances. The homeowner can finance the mortgage insurance premium as part of his loan. The third type of reverse mortgage loan expenditure are third-party charges. Closing costs from third parties can include a home appraisal, title search, insurance surveys, inspections, recording fees, mortgage taxes, credit checks, and other fees. The fourth type of reverse mortgage loan expenditure is the servicing fee. Lenders or their agents provide servicing throughout the life of the HECM. Services include sending the homeowner account statements, dispersing loan proceeds, and making certain that the homeowner keeps up with loan requirements, such as paying real estate taxes and a hazard insurance premium. Lenders may charge a monthly servicing fee of no more than $30 if the loan has an annually adjusting interest rate or has a fixed interest rate. The lender may charge a monthly servicing fee of no more than $35 if the interest rate adjusts monthly. At loan closing, the reverse mortgage lender sets aside the servicing fee and deducts the fee from the homeowner's available funds. Each month, the monthly servicing fee is added to the homeowner's reverse mortgage loan balance. Lenders may also choose to include the servicing fee in the mortgage interest rate. This table outlines the assumptions that were used to conduct a cost analysis for a specific type of reverse mortgage loan. In this example, it was assumed that a 70-year-old homeowner lived in a home with an appraised value of $250,000. It was also assumed that the homeowner would obtain an HECM reverse mortgage loan with a 20-year time horizon, and that the homeowner would elect the single disbursement option, carrying a fixed interest rate of 4.5%. Based on these factors, the principal limit factor was determined to be 49.3%. Given this information, the homeowner would have an initial loan balance of $123,250 and an equity reserve amount of $126,750. This table lists the one-time cost that would be charged to the homeowner for obtaining an HECM reverse mortgage loan. In this analysis, third-party costs were estimated to be $875. Third-party costs include a home appraisal, escrow, loan recording, a credit check, and title insurance. Such costs will vary by lender and geographic locale. It is important to note that a home appraisal is always required. The loan origination fee was estimated to be $4,500 based on the factors and calculations listed in the table. And the initial mortgage insurance premium was estimated to be $5,000 based on the factors and calculations listed in the table. A modest counseling fee of $125 was also included in this analysis. HUD mandates counseling with a third-party HECM counselor in order to obtain a loan. This fee will also vary by counselor and geographic locale. Based on these costs, the total upfront loan fees were estimated to be $10,500. Accordingly, the cash distribution would be $112,750. This amount represents the money that the homeowner will receive via the reverse mortgage loan. This amount is based on the initial loan amount of $123,250 minus the total upfront loan fees. This table represents the ongoing costs that are associated with the HECM reverse mortgage loan. Based on a beginning loan balance of $123,250, the borrower would pay $194,593 in interest expense over a 20-year time horizon. The homeowner would also pay $21,621 in mortgage insurance premiums and $7,200 in loan servicing fees over a 20-year time horizon. In total, cumulative ongoing costs would be $223,414. The table on this page lays out the cost structure of an HECM reverse mortgage loan in clear and concise detail. Based on this cost analysis, the total cost of the reverse mortgage loan over a 20-year term would be $233,914. implying an ending reverse mortgage loan balance of $357,164. This amount equates to a 5.332% annual growth rate in the cost of the reverse mortgage loan over a 20-year term. In return, the borrower would receive a single disbursement of $112,750, which would equate to $5,638 in additional annual income, or $470 in additional monthly income. It is important to keep in mind that the homeowner would still be responsible for annual property taxes, maintenance, and homeowner's insurance over the term of the reverse mortgage loan. Therefore, for many homeowners, the annual allotment of the single disbursement payment option for the reverse mortgage loan proceeds would not pay for all of the annual carrying costs that are associated with owning the home. The empirical results found in the Government Accountability Office report on reverse mortgage loans found three issues that need to be brought to the attention of prospective borrowers. First, the Consumer Financial Protection Bureau has received 3,600 complaints from borrowers about the reverse mortgage loans since 2011. Issues surrounding foreclosure, communication, loan origination, estate management, and fees and expenses were the primary complaints raised by borrowers. The following table outlines the types of complaints received by the CFPB. Second, the Government Accountability Office report found that the percentage of reverse mortgage loan terminations due to borrower defaults increased from 2% in fiscal year 2014 to 18% in fiscal year 2018. Most HECM defaults were due to borrowers not meeting occupancy requirements or failing to pay property charges, such as property taxes or homeowners insurance. HECM reverse mortgage loan terminations have exceeded new originations every year since fiscal year 2016. And third, since 2000, the HECM reverse mortgage loan originations take-up rate has been limited. The take-up rate is the ratio of HECM loan originations to eligible senior homeowners. The take-up rate, which provides an indication of how popular HECMs are among the population of senior homeowners, has not reached 1% and has fallen in recent years. According to the GAO, since calendar year 2010, the volume of HECM originations has declined and is about one half of what the originations had been at their peak. In calendar years 2007 through 2009, more than 100,000 new HECMs were originated each year, compared with roughly 42,000 in calendar year 2018. Prospective borrowers should consider many things before obtaining a reverse mortgage loan. HECM reverse mortgage loans have thousands of dissatisfied borrowers. Almost 1 in 5 borrowers have defaulted on their loan. The HECM loan originations take-up rate is less than 1%, and the current HECM loan volume is only about one half the amount that it was in 2010. Bank of America and Wells Fargo have exited the reverse mortgage loan business, ostensibly because they feared the risk of damage to their respective banking reputations if they foreclosed on seniors who defaulted on their HECM reverse mortgage loans. Reverse mortgage loans are expensive because they have high upfront costs and high ongoing costs. Prospective borrowers should remember that most reverse mortgage loans have variable interest rates that are tied to a financial index. This in turn makes it very difficult to estimate the total cost of reverse mortgage loans, particularly in a rising interest rate environment. Prospective borrowers should also remember that each month, interest expense is calculated not only on the principal amount received by the borrower, but on the interest previously assessed to the reverse mortgage loan. The only reverse mortgage loan payment plan that has a fixed interest rate provision is the single disbursement lump sum option. However, for many homeowners, the annual allotment of the single disbursement payment option for the reverse mortgage loan proceeds will not pay for all of the annual carrying costs that are associated with owning the home. Moreover, the Consumer Financial Protection Bureau has identified the lump sum distribution option as potentially risky for younger borrowers with longer lifespans because such loans place these borrowers at risk of using up their home equity early in their retirement. Again, borrowers should remember that reverse mortgage loans reduce the amount of financial assets that will be available to bequeath to the homeowner's heirs. In addition, homeowners that are put in nursing homes for more than 1 year may violate the provisions of the reverse mortgage loan contract and therefore be forced to sell their homes. With these issues in mind, the GAO has determined that the FHA needs to improve the monitoring and oversight of reverse mortgage loan outcomes and servicing. Overall, the terms and conditions for reverse mortgage loans are complex and comprehensive and take a significant amount of time and effort for homeowners to understand. Unfortunately, most people have neither the financial education nor the time and interest to learn about all of the intricacies that are associated with reverse mortgage loans. This problem is compounded as people age and start to lose their mental capacities. This review of HECM reverse mortgage loans provides a comprehensive and objective evaluation of the issues that are associated with these types of complex financial products. Based on this review, there are more than a dozen material issues that should dissuade most homeowners from obtaining a reverse mortgage loan. Homeowners that need to increase the amount of income at their disposal should consider selling their home, downsizing to a less expensive home to live in during the remaining portion of their lives, and using the residual capital to meet their financial obligations. A second option would be selling their home, renting a less expensive home, apartment, or condominium to live in during the remaining portion of their lives, and using the residual capital to meet their financial obligations. Their third option would be staying in their home, allowing a friend to move into their home as a paying tenant, and using the income received from the friend to meet their financial obligations. Or a fourth option would be staying in their home, selling their home to their children, paying rent to their children as a tenant, and having their children serve as a landlord investor. Notwithstanding the overall theme of this presentation, for homeowners that are facing financial peril, a reverse mortgage loan may serve as a feasible last-ditch effort to monetize a portion of the appraised value of their home in order to bolster their monthly income during their elder years. For homeowners that are financially stable and are financially astute, a reverse mortgage loan may serve as a valuable financial tool. Reverse mortgage loan proceeds have a moderate hurdle rate that can be greatly exceeded by investing the loan proceeds in the global capital markets. In this presentation, the cost of the reverse mortgage loan only increased by 5.332% each year over the 20-year term of the loan. In comparison, the year-to-date return on the S&P 500 index is approximately 26.5%. In this presentation, the appraised value of the home would only have to increase each year by 1.793% in order to offset the costs of the reverse mortgage loan. Assuming that the market value of the home exceeds its appraised value, the annual required increase in the market value of the home is a very attractive cost for investment capital. Reverse mortgage loans provide astute homeowners with the opportunity to utilize financial leverage in order to bolster their net worth. The non-recourse clause in HECM reverse mortgage loans gives homeowners a built-in put option derivative feature that is tied to the value of their homes. Homeowners will never owe more on their reverse mortgage loans than the value of their homes. This put option provision limits the downside risk of reverse mortgage loans and would serve as a valuable feature if there is another housing crisis. Reverse mortgage loans exhibit both tangible benefits, such as a place to live, and intangible benefits, such as investment capital. Nevertheless, HECM reverse mortgage loans were not created in order to help investors bolster their net worth. Therefore, reverse mortgage loans should not be evaluated from this perspective. This comprehensive analysis is based on information and data provided in the Government Accountability Office report titled Reverse Mortgages. FHA needs to improve monitoring and oversight of loan outcomes and servicing that was submitted to congressional requesters in September of 2019. Comprehensive information about the Home Equity Conversion Mortgage Loan Program, including HECM principal limit factors, can be found on the HUD.gov website. For more information, the National Council on Aging has published a free guide for seniors who are considering a reverse mortgage loan. The title of the guide is Use Your Home to Stay at Home. In closing, it's important to note that the contents of this presentation were researched, analyzed, written, edited, narrated, produced, and published by Troy Atkins. Mr. Atkins is the founder and owner of Atkins Capital Management. The contents of this report are the property of Atkins Capital Management. No part of this report may be reproduced, redistributed, displayed, or transmitted without the written consent from representatives of Atkins Capital Management.